2026, four companies, Microsoft, Amazon, Google, and Meta, plan to spend roughly $700 billion on capital expenditure, most of it AI infrastructure. That is more than the GDP of Switzerland, deployed in a single year by four firms. Meanwhile, the most famous AI company on Earth, OpenAI, expects to lose about $14 billion this year. Read those two sentences again because they describe the strangest economy ever built. Record spending at the top, record losses in the middle, and at the bottom, a study out of MIT finding that 95% of corporate AI pilots produce no measurable return. So where is the money actually going? Someone in this chain is getting rich. Genuinely, historically rich. Today we follow every dollar through the AI economy, layer by layer, and find out exactly who keeps it. Picture the AI economy as a 5-layer stack. At the bottom, chip designers, and really one chip designer, Nvidia. Below even them, one manufacturer, TSMC, the Taiwanese foundry that physically makes the chips. Layer 3, the clouds, Microsoft, Amazon, Google, who buy those chips by the million and rent them out. Layer 4, the model labs, OpenAI, Anthropic, who rent that compute to train and run frontier models. Layer 5, the application layer, thousands of startups wrapping those models into products. And beyond them, the labor market where AI meets actual work. Money enters at the top as your subscription, an API bill, or an enterprise contract, and cascades down. Here is the rule that explains this entire episode. At every layer, ask one question. Could the buyer go anywhere else? Where the answer is no, profit pools. Where the answer is yes, it evaporates. Start where the answer is most clearly no. In its fiscal year 2026, which ended this January, Nvidia reported $215.9 billion in revenue, up 65% in a year, with $193.7 billion of it from data center chips. Gross margin, 71.1%. Net income, $120.1 billion. Sit with that. For every dollar of AI chips sold, Nvidia keeps about 71 cents before operating costs, and over 55 cents lands as pure profit. Margins like that normally exist only in software and pharmaceuticals. Nvidia gets them on hardware because of CUDA, its software ecosystem, 15 years of developer tools that every AI framework is built on. Competitors can match the silicon. They cannot easily match the switching costs. When Microsoft spends $100 billion on infrastructure, a huge slice flows through this toll booth, and $71 of every $100 of chip revenue stays there. Layer 1 verdict, rich, spectacularly rich. But Nvidia does not actually make anything. Nvidia designs chips. TSMC builds them, along with Apple's, AMD's, and nearly every advanced chip that matters. In 2025, TSMC booked roughly $120 billion in revenue and around $54 billion in net income. With gross margins near 60%, high-performance computing, mostly AI, is now about 55% of its revenue. And here is the strategic reality. At the leading edge, there is no real alternative. Intel is years behind on foundry services. Samsung struggles with yields. If you want the most advanced AI silicon on Earth, you stand in line in Taiwan. That is why TSMC can charge what it charges, and why it is spending $52 to $56 billion this year on new capacity, including a $265 billion build-out in Arizona. Notice the pattern versus Nvidia, monopoly-grade pricing power at both layers, because both answer no to our questionnaire. The buyer cannot go anywhere else. Layer 2 verdict, rich. Now the money gets weirder. Layer 3 is where profit turns into faith. Microsoft, Amazon, Google, and Meta are the ones writing that combined $700 billion of checks in 2026, up from roughly $400 billion in 2025, which was itself a record. Where does it go? Chips to Nvidia, construction, land, and power. So much power that data centers are reshaping electricity markets. What do they get back? Cloud AI revenue is growing fast, and the clouds do run profitable businesses underneath. But the AI-specific return is an open question. Analysts note the gap between AI capex and AI revenue is widening, not closing. The hyperscalers are effectively pre-buying the next decade of computing and betting they can rent it out later. They are the railroad barons of this cycle, laying track ahead of demand, financed by cash flows from their old monopolies: Windows and Office, retail, search, and ads. Layer 3 verdict: not getting rich from AI yet. They are the ones paying. Layer 4 holds the most famous names and the worst economics. OpenAI's revenue is genuinely enormous, from $3.7 billion in 2024 to roughly $25 billion, annualized by mid-2026, one of the fastest revenue ramps in business history. It still loses money on a heroic scale, around $14 billion projected this year, with internal documents pointing to cumulative losses over $100 billion before hoped-for profitability around 2030. Anthropic runs about $8 billion annualized and is likewise deep in investment mode. Why? Because every dollar of model revenue requires buying compute from Layer 3, which bought chips from Layers 1 and 2. The labs sit mid-chain with monopolists below them and price-sensitive customers above them, and their product half commoditizes every year as rivals and open-source models catch up to last year's frontier. Their bet is that frontier capability eventually becomes a durable moat. Verdict so far: famous, valuable on paper, and not yet rich in the only sense that counts, profit. Now connect the layers and something strange appears. The money is circular. Microsoft invested about $13 billion in OpenAI, much of it as cloud credits, and OpenAI spends it right back on Azure Compute. Amazon put $8 billion into Anthropic, which trains on Amazon's chips and clouds. Nvidia has pledged tens of billions to OpenAI, which uses it to lease systems full of Nvidia GPUs. Venture money floods the app layer, which spends it on model APIs, which spend it on cloud, which spends it on chips. Trace any dollar in the AI economy far enough, and it lands in the same two vaults, Nvidia and TSMC. Everyone above them is, functionally, subsidizing the layer below. The bulls call this an ecosystem investing in its own future. The bears call it vendor financing, the same accelerant behind history's biggest bubbles where suppliers fund their own customers' demand. Both can be true at once. They have been before. So here is the midpoint question, the one this whole edifice rests on. Does AI make enough real-world money at the top of the chain to justify $700 billion a year at the bottom? Right now, honestly, no, not yet. That MIT finding that 95% of enterprise AI pilots show no measurable ROI went viral precisely because every executive recognized it. The pilots fail for mundane reasons: workflows, data plumbing, organizational friction, not because the models are weak, but mundane failure still means the revenue arrives later than the capex. The entire boom is a timing bet. Infrastructure is being built at 2030's scale and billed at 2026's demand. History has run this exact experiment twice. Capital racing ahead of revenue, builders convinced demand will catch up. Both times, demand did eventually show up. And both times, the money ended up somewhere nobody expected. Let's run the tape. The railroad was the transformative technology of the 19th century, and investors correctly saw it coming. Capital poured into track the way it pours into data centers now. Then came the crash. After the panic of 1893, roughly a quarter of American railroads fell into receivership, the Union Pacific and Santa Fe among them. British investors who financed the boom were wiped out in waves. Here is the paradox that should be tattooed on every AI investor's forearm. The railroads did transform the economy exactly as promised. The technology succeeded and its financiers still lost, because competition and overbuilding crushed the returns on the infrastructure itself. Who won? The users of cheap freight. Carnegie moving steel, Rockefeller moving oil, Sears shipping catalogs to farmhouses. The fortunes were built on top of the rails, not in them. Remember that inversion. It happens again, almost beat for beat, a century later. The late 1990s telecom boom was the same movie in fast forward. Convinced internet traffic was doubling every 100 days. It wasn't it. Companies like WorldCom and Global Crossing borrowed fortunes and buried millions of miles of fiber optic cable. By 2002, as little as 3% of it was actually lit. The rest sat dark. Hundreds of billions of dollars of market value evaporated. WorldCom became, at the time, the largest bankruptcy in American history. And yet, the fiber worked. That dark fiber, bought for pennies on the dollar out of bankruptcy, became the cheap bandwidth that made YouTube, Netflix, and cloud computing economically possible. The bubble's losers involuntarily donated the infrastructure for the next generation's fortunes. Google and Amazon got rich on rails someone else paid to lay. So the pattern, twice confirmed, infrastructure booms transfer wealth from the people who build the infrastructure to the people who use it. Now, who are AI's users? Layer 5 is the messy frontier where AI meets actual work. App startups wrapping models in interfaces have a structural problem. Their costs flow down to monopolists, and their features can be absorbed by the model labs above them overnight. A few will find real moats in proprietary data and distribution. Most are renting their existence. The deeper action is in labor markets. AI's real economic promise is doing cognitive work. Coding, analysis, support, paperwork, cheaper than salaried humans. If that holds, the biggest winners are not AI companies at all. They are whoever buys cognitive work at scale. Enterprises that convert AI into margin and skilled individuals who convert it into leverage. One developer shipping what once took 5. The corresponding losers are the workers whose output gets commoditized without gaining control of the tools. The value does not disappear at this layer. It disperses into prices, profits, and wages, where it is enormous but nearly impossible to tick a symbol. So let's call it. Right now, the picks and shovels layer is capturing almost everything. Nvidia and TSMC are banking a combined $170+ billion a year in profit, while nearly everyone above them runs at a loss or a bet. That is the classic early boom shape, but the railroad and fiber precedents say toll booth margins are a phase, not a law. 71% margins are a siren call to competitors, custom silicon, and time. As compute gets cheap, history says value migrates to whatever stays scarce when the core technology no longer is. Watch 4 scarcities. Electric power, already the binding constraint on data centers. Distribution, whoever owns the billion-user doorway, which is why Microsoft, Google, and Apple may win the application era by default, proprietary data and trust. And human judgment that directs the machines. The boom's spending is real either way. Booms always leave the infrastructure behind. The question is only who inherits it, and at what price. So, who actually gets rich from AI? Today, the toll collectors, Nvidia and TSMC, and they are already historically rich. Tomorrow, if a shakeout comes, whoever buys the overbuilt compute at a discount. The way Google once bought dark fiber. And in the long run, if the pattern of every general-purpose technology holds, the users, businesses, and workers who apply cheap intelligence to old problems, capturing value no chart of the AI sector will ever show. The famous names in the middle may end up like the railroads, transformative, celebrated, and surprisingly poor. To be clear, this episode is education, not financial advice. Nothing here is a recommendation to buy or sell any stock, and booms this large can break in ways no framework predicts, so do your own research and talk to a licensed professional. If you want the machine economy explained one money trail at a time, subscribe. The next trail leads somewhere stranger.